Good morning. Today is the 5th of October, and we had a pretty exciting week after waiting around for NFP for quite a while. So, Andy, has everything changed after that very strong NFP number with strong revisions as well? Something that really the market was not expecting. What do you think?
Yeah, I mean, I think the market changed without a doubt. 2-year yields rose 25 to 30 basis points over the last week, most of it on Friday. But has the Fed changed is the question. And when I think about what the Fed has done, they were aggressive, cutting 50 basis points in September, and were very dovish in subsequent discussions, teeing the market up to the possibility of successive cuts of 50 for the next two meetings, while at the same time cautious on their SEP dot plots with 18 of the 19 members penciling in only two cuts of 25 or less, with 9 saying we're only going to cut once between now and year end. So the SEP dot plot and that would only occur if inflation went to target or below, went to target, and the jobs number, unemployment rate, went to 4.4%. So the market took that as saying there was a high probability of two 50 basis point cuts. And now we're basically saying, no, 25 is what's going to happen in both meetings. And so for me, that just said that whatever happened just got the market's enthusiasm about extremely rapid cuts to a very low terminal rate and positioning that fit that scenario and reversed it essentially on a single number.
Yeah. I think I agree that what the market is now going to have to come to terms with is that the terminal rate is unlikely to be where they were hoping it would be, i.e., around the 3% area or even slightly lower, and that it's likely to be in the range of 3 to 3.5% given what we know now. Now, that could easily change, but what we know now, and unless inflation starts reaccelerating as well, I think that there's very little likelihood that the terminal rate is going to be below 3, very small likelihood that inflation stays anywhere but in the 2 to 2.5% range. And if that is the case, then the market is appropriately priced as it is for the time being, with long bonds around the 4.25% area. And really, the equity market is not going to get a lot of help from the bond market going forward. But, inflation will decide. It's no longer, I think, a game of employment, because I think the employment numbers are now. Let's just step back. We've been saying for a long time, where is this recession in the data? And the market was really beginning to price in some likelihood of a recession, certainly in the bond market. We can no longer do that because there absolutely is no recession round the corner that we can see in the data. I think anybody will agree with that now. And if that is the case, then we need to revert to a normal upwardly sloping yield curve with a terminal rate somewhere in the middle threes and a 30-year bond trading around the 4 to 4.25 area. A normally positively sloped yield curve, which is a Goldilocks scenario, and the Fed shouldn't really have any objections to that kind of a scenario because the economy is still growing at 2.5 to 3% real. Inflation is still 2 to 2.5%, and everything is fine. It's still a scenario which, in the end, favors equities over bonds. Is that what you think, Andy?
Well, I think we disagree, Nick, frankly, what I think is important when you look at the economy, and I think when we step back, our view has been 100% consistent, and we agree that there is no sign of recession, that the economy is strong, real GDP is strong, employment is strong, and there's no sign of a recession. Where I think we disagree is on inflation. And when I look at the path of inflation, it is clear that 4 months in the past, inflation has been the 4 month moving average of inflation data has hit 2%, has hit target, possibly even a little below target. But when you look at the future of inflation, you have a global central bankers that are more dovish today than they were 2 weeks ago. You have China stimulating, whether that'll be enough and whether there'll be more is certainly important. And you have a employment situation in which the Fed and consensus expected 4.4% unemployment rate, and we're at 4.05% today. So, in my view, the economy, consistent with our long term view, the economy is strong, and where Nick and I differ is the impact on inflation. And he may be right, I may be right, but I think inflation will stay sticky. Listen, I think 2.6 is the likely print when it comes to the SEP next in December. So that hits their target. It's still well above target, but it hits their target. The UR rate could easily be 4.1 or 4.2, not the 4.4 they penciled in. And the GDP is likely to be higher. So to me, that means that the 225 basis point cuts, the market is now going to question them on whether there's going to be a pause. Now, this will all swing. It swings all the time. And the swing will depend on this week. So, right. So where Nick will be right is if the CPI comes in cold. Where I will be right is if the CPI comes in hot. And in line, it'll still be undetermined. And then we'll have PPI, which is related. We'll have the another non-farm payrolls before the Fed meets. But right now, the market has gone from a 50-50 chance, well, even higher at one point, of 50 basis point cuts down to a virtual certainty of 25 basis points cuts in its pricing. And in fact, it's actually now pricing in a tiny probability of no cut in November. So the inflation number will likely validate that pricing or throw it on its head.
Okay, so because the only really important data next week is CPI and PPI, and from that we'll be able to infer what PCE is. And apart from the auctions, we have threes, tens, and thirties, but we have those, every month. So the market is now going to be prepared for these auctions and is probably going to get them at a very good level. What do you think the consequences of a hot CPI number are? Because I think they are going to be disastrous for the bond market. Because at the moment, our pricing is, as I've said, is for a normal inflation target hitting the target between 2 to 2.5% and remaining there. If employment is strong and inflation accelerates, I think the bond market is completely mispriced. What are your thoughts?
Yeah, I mean, short term, a hot number above target, it's around zero point 0.2, say it's rounds to 0.3, to me would seriously question and possibly increase the probability to likely that the Fed won't cut at all in November. That'll raise a question on the whole curve about whether cuts are done, if there's a 50 basis point one and done. Now, obviously, data subsequent will matter on that, but this week, November could come off the board as a likely outcome. December will come off the board as a likely outcome as well. It won't just be November. And the terminal rate will be, instead of, where it had been, which was sub 3%, will be closer to the top end of the range that we are talking about, like 3.5 or 3.75. So that's pretty disastrous for the bond market. And so ahead of this, we saw a big sell-off last week. I would expect further sell-off in the next Monday, Tuesday, and Wednesday. We haven't talked about Israel. They're likely to give a response that could have some impact on inflation expectations, particularly as it impacts oil, or not. And the auctions will, the market makers will price these things so that the auctions go well. And so that, to me, means short-term pressure on the bond market, and then the CPI. And longer-term pressure on the bond market would occur if the CPI is hot.
Yes, I completely agree with that. If the CPI is hot, the bond market is in a world of hurt. And we can discuss what the yield curve would look like, but I don't think that's appropriate at the moment. But what do you think the effect is on equities? Because my own feeling is that if CPI is now hot, if the economy is running hot, there is absolutely no way that the Fed is going to even allow talk of hikes again, right? So we know that there's absolutely no chance. At worst, they pause and wait for another opportunity to cut. But to me and to the bond market, I fear this is going to say that they are quite happy with an inflation target, with a new inflation target, which is above the 2% that they have set themselves. And really, then you are looking at a world in which inflation is going to remain hotter than target for probably many years, right? I mean, it's not something that's going to be transitory, it's something that's almost permanent. And then you really have to start questioning, especially after the election and after the fact that, whichever candidate gets elected, they have absolutely zero plan to reduce the deficit. Then you have to really start asking yourself about a completely different asset allocation than the one that we have at the moment.
Yeah, that's out there in terms of expectations. What I care about is what the Fed actually does. And to me, the asset allocation decision would depend on whether the Fed continues, for whatever reason, cutting into hot data. If they do, I agree, they are ignoring their inflation mandate. And that's certainly a possibility. But, most of the rhetoric, except for possibly Chris Waller, most of the rhetoric from the Fed and the dot plot is concerned about the jobs mandate. And I don't know. This is just one number, and we've been saying one number shouldn't make much of a difference, but it clearly did. And so I'm a little surprised. It may take another number to convince people, but certainly an NFP that doesn't show any signs of weakening by November 1st, and we'll know whether the Fed is intending to ignore its inflation mandate, even if inflation comes in at target, because when you roll ahead to the SEP in December, and the unemployment rate doesn't even come close to hitting the unemployment rate they were concerned about, and inflation hits target and GDP is hotter, why are they cutting?
Yeah. And the bond market in that case will be a lot worse than it is at the moment, but that will have a repercussion on equities as well
I was
through
thinking
the
about
multiplier.
equities, and you know, there's two things that drive equities. Multiple expansion, which comes from whether the Fed is too easy relative to conditions or too tight relative to conditions, which sort of is a valuation dynamic, and earnings. And earnings are dependent on the level of nominal GDP, which is a combination of real GDP, which we said is strong, 2.5%, 3%, and inflation. And so the dynamics for equities are likely to, in a Fed that sort of sticks with the normalization that they have in the penciled in SEP and maybe tweaks it a little bit because of the incoming data, multiples are not likely to expand. They had expanded when the market had expected the Fed to be very aggressive easing. And so to me, the multiple should have contracted a little bit on the data last week. And the earnings expectations should have improved based on the data last week. Those two things offset each other. And not surprisingly, the equity market closed where it opened. So I expect further things like that, which is good data, meaning strong real data like employment and GDP, is good for equities. Inflation is not good for equities. And the way the central bank responds to those things, either by cutting into strength, which is fantastic for equities, or not cutting into strength, which is neutral to equities, or the economy weakens, which is bad for equities, is the way to trade equities right now. And ahead of the election, I don't think there's much to do.
Yeah. So we are basically saying that something big could change over the course of the next month or so. And really, it's still a period that is so uncertain that one should have a lot of cash at hand and not take any big risks right now. Because whatever happens over the course of the next month or so is going to have very important reallocation potential. So either we're going to go heavier in equities, heavier in gold, and heavier in commodities, and really basically abandon bonds altogether, or just go into reals again, into tips, as sort of STIP, TIP, that kind of ETF, or we are at a place where investing in long-term bonds and duration is actually quite good, but we'll only know that over the course of the next month. Is that what we think, Andy?
So I think we're getting bogged down a little bit. So let's just sort of simplify things. The economy is strong.
Yeah.
Inflation, Nick and I disagree, but who knows? We'll see what the outcome is. And the Fed is on a path to cut rates. We think it's probably less aggressive and more and to a higher rate. But what does it matter for assets? If we have a hot inflation print, everything's going down. Stocks, bonds, probably not gold, and probably not commodities, but everything's going down. If we have a cold inflation print, bonds will like that, and stocks will too.
Yeah, I absolutely agree. I think this inflation print is going to set the tone for the next several weeks. As you said, if it's cold, the long end will like it, and I don't think the short end is going to be too upset by it by any stretch of the imagination. But I think the equities will certainly like that because they'll have a reassurance that the Fed is still on track to ease. The long bond is helping them with the multiplier, and therefore I think equities will probably really like it, and they'll probably be up by a couple of percent. The bond market, I fear, is not going to like it as much as equities. although they will like it, simply because the likelihood of a terminal rate below 3 or 3.25% to me now is very, very low. Inflation would have to be at target or below target. And before year end, I think there's very little likelihood of that happening. Therefore, the short end really is stuck within 10 or 15 basis points of here. And the long end is also stuck within 15 and 20 basis points of here. So the bond market is more or less stuck within 3 or 4% moves on the ETFs, but really equities and commodities as well could start performing better going into year end, naturally, depending on the election. So we will reallocate. It's just that we feel it's the wrong time to reallocate right now. Okay, that's that.
Okay.
Okay, so that's really all we have at the moment, and the overarching message is stay small on risk at the moment, because over the course of the next month, big things will happen and we'll have so much more clarity, and we'll be able to really position the ship in the direction that the market will go. At the moment, it's all so uncertain. We really have to wait, and this is the worst time to add on too much risk.
Absolutely.
Thank you very much.